Welcome to this episode of Whiskey WealthTech. I'm your host, Alex Serman, Managing Director of Wealth and Institutional at First Rate, and I am here in Toronto, as you can see by my background, at the CN Tower, behind us with Carol Penhale. Carol, welcome to the episode.
Thank you, Alex. Happy to be here. Thank you. Welcome to our office. Great backdrop for us to share some whiskey, talk about wealth tech, two of my favorite topics, and see what mischief we can get into this afternoon. Thanks for having me.
Awesome. Well, let's dive right in. So, Carol, tell us a little bit about yourself. What do you do? What your role is. We're here at the Rhymes offices in Toronto, but what all do you do for Rhymes?
So I'm head of Canada for Rhymes. This is one of our offices globally. We support 400 clients across the globe. We supply data and solutions to the industry, primarily the buy side, but not exclusively. We work with non-discriminatory. We work with custodians and banks and sell side as well. And my role here is to get the word out. I've been in the industry a very long time, and I joined Rhymes May of last year because we have an awesome story to talk about issues that are plaguing the industry, and we have great solutions for them on both the data side and the solution side. We're going to talk a little bit about some of those today.
Absolutely. Well, without further ado, the first word of the podcast name is whiskey. So let's dive right in.
Right priorities, good priorities.
So we've got a Glen Breton 10-year-old single malt here, which is the first single malt in North America, according to the box, at least. So cheers to that. Well, that's fantastic. I know they've won a bunch of awards over the years for how well this single malt has done, and I can see why.
Oh, yeah, that's quite tasty. I might have to do this every afternoon. Are you coming back tomorrow? So, this is quite tasty. Quite enjoying this. And this is actually, so talk about a North American partnership. This whiskey, from what I understand, well, it's made here in Canada, but it's aged in American oak barrels. So we bring the barrels up from the U.S. and we age this amazing whiskey here in Canada.
Yep, and so that's why we get this nice, lovely light golden color here from that bourbon barrel, and you get a little bit of vanilla, a little bit of
lots of butterscotch.
A lot of butterscotch. When I first smelled this, I thought I was getting some cherry on it. I could be wrong, but I had a little bit of that sweet fruit note to it.
And look at the viscosity on the glass. Nice legs on the glass. I like to see that. I mean, you talk about that more in wine than you do whiskey, but I always think that's a good sign of something that has aged well in the barrel. My understanding is they age it in barrels, obviously, in the apple orchard outside of the distillery in Cape Breton.
Interesting. So that is definitely a unique place to have your barrel house, and so whatever they're doing, it's clearly working very well. And so this is a fantastic single malt, and unfortunately one that I've never seen in the States. So hopefully I can find some down when I go back home.
Oh, well, I'll have to figure out how do you get some and take it home. I'm assuming you're allowed to take it across the border.
Yes. There are limits, but I know all of them.
So, I'm sure you do.
So that'll be good because the Canadians seem to like to keep all the good Canadian whiskey up here.
Well, it's just exciting that we do have whiskey here, and I'm sure your audience is very seasoned, but this is truly a whiskey that's made from barley as opposed to American bourbon, which is made from corn. Or Canadian. People think Canada. Oh, we think Canada rye, a rye-based whiskey. And when I told folks I was doing this podcast, I said, "Are you going to take a Canadian rye whiskey?" And I'm like, no, we're sticking to barley. Come on.
Yeah, we got it. We're both Scotch lovers at heart, so
that's right.
Going with a single malt here.
Exactly.
Well, excellent. So, Rhymes, you talked about what you're doing with data, mostly working with the buy side, some with the sell side. A lot of the data that we're seeing and a lot of the topics that we're seeing is really around alternative assets, privately held assets. What are some of the issues that you're seeing with getting quality private asset data and delivering that to your clients?
Oh, yeah, very topical. Private investment data, it's growing in terms of both institutional and retail accounts, as you know. And so it's becoming a growing topic in terms of interest. But I would say we see the same issues. I've seen the same issues for public data as I do on private, for data quality, data timeliness, and data granularity. and it's on steroids when we start talking about private data.
Okay.
Because if we try to talk about public data, an equity trade, you and I could both list 10 fields of data you would need for a trade,
Mm-hmm.
and we'd know exactly how to close it.
Yep.
So anything in the alternative space, that's very different.
Mm-hmm.
We'd list 10 fields and they wouldn't necessarily match. And so the data complexity that comes into play for the private side, much more horrendous than on the public side.
Absolutely. And so, you mentioned this is growing for both retail and institutional investors. So
Yep.
are you seeing differences in how these different types of investors are utilizing this data, or different kinds of quality with the data between these two types of investors?
I would say yes. On the institutional side, pension funds, insurance companies have been investing in private investments for a long period of time, because there just isn't enough on the market. They need higher rates of return. Those are somewhat afforded quite often, or people perceive they're afforded on the alternative investment side. And maybe we should define that for people, Alex, who are listening, who may be Scotch drinkers and not private investors. And although the two go hand in hand.
Yes.
So private equity, real estate, mortgages, infrastructure such as wind turbines, oil and gas in some cases, anything that's not listed on an exchange is typically what we would see in the private investment space. And it's a growing portion. And in fact, if I look at, I did some research recently. Really, I do have a life. It's not that, but I did some research recently for growth of the marketplace here in Canada and in North America in general. And Canadian pension funds have a tendency to be in the 30 to 40% range for private investments, whereas the typical norm globally for private investments is more around 10 or 11%. So it's a very big number here.
Interesting. Why do you think that is?
I don't really have a good answer for that. Okay. I can just talk to you about the trend, but it's something I've seen with pension funds here in North America for a long period of time. But if I compare Canada to the US, Canada has much more total return pension funds than in the US, where it's more private investment and private investment in 401ks, so institutional side. Yep. And so they've approached the market differently. So we could talk about target date funds.
Yeah.
Because you would see that a lot in the States. We're not seeing that as much here in Canada, but certainly we have a great solution for target date funds here at Rhymes. And we're starting to see people take private investments and put them into the glide path for the total TDRs. So I'm starting to lose my words and I'm using acronyms already. I haven't even had half a glass yet. So.
Well, and so with those target date funds, now that we're seeing more of a trend of people putting private assets in there, what are the results of that? Are people seeing better results from doing this? Are they having better conversations with their the end clients?
So I think it's still too early to tell on the TDRs, but I think certainly think it's a good vehicle for investing private investments because of the long glide path. So on a target date fund, you're looking at a 20 or 30-year horizon, and a lot of the private investments that people get into have that type of horizon as well. And so if you think of the antithesis of that in terms of your average retail investor, and you go and say, we're going to give you the stock, it's on this exchange. If you don't like it, you can sell it tomorrow. You can't do that with a private investment. In fact, most of them have cash outflows before you start to see cash inflows. So they're definitely a longer term horizon investment, and liquidity is really not their forte. So if you have people who are nervous about those long term horizons in the retail space, that's difficult to explain. But secondly, the level of sophistication of investors on the institutional side is generally much higher than on the retail side. And the entire scheme in terms of, I don't mean that word in a bad way, but how you look at a private investment and what do you measure that against. If I buy some ABC stock today, I can look at the exchange and see what it closed. If I buy that building across the street, well, I'd be very wealthy. I wouldn't be sitting here with you, Alex, but if I bought that building across the street, how do I value it today versus the stock I have in an exchange? And that becomes much more subjective. And on the institutional side, people are a little more comfortable with that. On the retail side, there is a lot of hand-holding for the typical advisor to have to explain that to their investors in terms of what they're in. And I think that's why the TDRs are good for that type of vehicle, because they know up front it's going to be a long-term investment. They've already gotten into the mindset it's set. It's going to be there for 20 years. I'm working on the glide path. So it makes it easier for the longer term investments. And then somebody internally has to make sure they get out and exit at an appropriate time for their retirement horizon.
That makes sense. And so what is Rhymes doing today to help kind of address some of these concerns, some of the granularity, some of the issues? I know we have clients that talk to us that getting their exposure data, getting look-through data can be a real challenge. And so you mentioned you have a great solution for target date funds, but so what are the great things that Rhymes is doing to help firms with this?
So I would say that's one area that we have solutions for target date funds. So if there's anybody in the institutional space who drinks scotch who's watching this, give us a call. We can help. But there's a couple of other areas that we should focus on in the private space. One is data. So we have over 800 suppliers of data globally, representing 1,500 sources. We're adding to it all the time for index data. And a lot of those include private investment data. Private equities, real estates, mortgages. So we're a good source for that data as well. And a lot of people are not as familiar with those sources of data to bring to the table as, say, publicly listed securities. So those are a couple of areas in particular. And then, we do ID matching for clients who are trying to compare data from different sources on the public side. And it's fairly easy. I'm going to get technical for a second, but it's fairly easy to do on the institutional side because you can match it against the LEI, the legal entity identifier. And so the QSIP, the ISIN, or the CEDAW. But on the private side, there is nothing like that. So we're playing a little bit, and I don't mean that term in a bad way, with fuzzy logic and non-ID matching. How do you compare these different companies and figure out if you're talking about the same investment or not when you're managing multiple sources of information? So those are three areas, because a lot of this is still very cutting edge. And so those are three areas that we're helping.
Excellent.
And then at the top of the list is asset allocation, modeling, rebalancing, portfolio construction. We're asset agnostic. So that's the number one challenge I see with chief information officers and chief investment officers is how do I get a consolidated view so I can decide today, how do I spend the money that came in overnight? Do I buy this stock off the security exchange, or do I buy this building from Carol that she owns across the street? And so trying to get an idea what that purchase looks like is still a challenge for many firms at the institutional side, or if they're managing money for the retail side, is what's the best spend today. And so when you have portfolio construction tools that are asset agnostic and can handle all those types of investments, it gives the chief investment officer a better idea of start a day. Where's the risk? Where should we spend our money today? So those are four things.
Excellent. So it sounds like you have quite a few things that you're using to help the market, help firms make better decisions with their data, which is key. Everybody wants to have more data, but whether or not they can use that data well can be a real challenge.
Exactly.
And so what are some of the trends that you're seeing outside of just what we've talked about so far in wealth management, wealth tech, that you think are going to be big over the next couple of years?
The biggest one, and it's going to be more than the next couple of years, and I think people are still trying to wrestle their heads around it, but it's the shift in the boomer wealth to the next generation. And it's how long the boomers live in terms of what that next generation is. Because quite often it could be a couple of generations down. So while you need paper for the boomer generation, the younger generations are like, they have an allergic reaction if they see people arrive in their mailbox. They're looking totally paperless. So that's probably the biggest trend that I think we're seeing, is that seismic shift in terms of the mentality and the investors that are coming in. I would say if there's another area that's a bit of a trend is in fully paid lending for the ultra high net worth. And so I'm not going to go, we can do another bottle of scotch on another day. We can talk about fully paid lending, but that's certainly something we're seeing as a trend in North America, Canada, and the US, people trying to retain ultra high net worth clients, which is, how many less of 1% it could be. It's a very small group, but that's the highly coveted box that people are going after.
Mm-hmm.
But where I've seen firms tackle fully paid lending for more smaller accounts. So, who do we talk about? Like the Wealth Simples and that type of firm where they
Mm-hmm.
don't charge for commissions. There's a lot of people who think they're day traders. They're
Mm-hmm.
not huge accounts. The types of securities they're buying
Mm-hmm.
are less attractive quite often for securities lending than the ultra high net worth, who are older folks and may have what I think we used to refer to as blue chip stocks, as opposed to, evolving, scary, keep you up at night, awake stocks.
They're not going in for Bitcoin or things like that.
Not as much. So it'll be interesting to see how that trend evolves over the next couple of years. Are you seeing a lot of fully paid lending in demands in your shop?
We're not seeing all that much, but we tend to not stay in that side of the equation.
Yes, yeah, of course, I totally get it.
But we are seeing with the shifts in going from the boomer generation to the next generation, excuse me. There are quite a few trends even within that, like the transfer of wealth, really primarily from men to women, because women are living longer. They're outliving their husbands. Potentially their husbands were the ones that handled all the finances, things like that, and now women are in charge and running the finances. And so that's been an interesting trend to see as well, that you're having to address a different type of clients that you might not have worked with as closely over the years, and what that trend's going to do, because I think that transfer is going to continue to grow even into younger generations as well.
I think that's an excellent observation, because there's a lot of women who have older generations. I even see that with some of the younger generations, and they leave all the money decisions and credit cards and mortgages and everything to the husband.
Mm-hmm.
And so once they're not in the picture anymore, for unfortunate reasons, the learning curve is pretty steep. So you must deal with that every day.
Yes, so we see that, and so there's a lot of things that people are doing to try to address that need.
Yes.
So it's very interesting to see, but I completely agree with those trends that you're seeing there. And so I'll end with one last final question.
Sure.
That might be a little less technical, but
okay.
You've had a long career and a very successful one. So I'm curious, what have you felt's been the most rewarding aspect of your career, or just the best experience that you've had so far?
Well, that's really difficult to. I'm still happy that there's capital markets in Canada, because there was a time in late 1999 where some of us, everybody was moving to T+1. I'm like, this is going to be a problem for capital markets globally. Mm-hmm. I'm still hoping there'll be capital markets when my son grows up. But I went back to school and took a degree in programming and systems analysis, which was kind of a risky thing to do. Mm-hmm. There's only two things I'm afraid of: regret and spiders. And so generally financial services offices are free of spiders. So I've tackled that. But on the regret side, I went back to school and took a degree in programming and system analysis, because I worked mainly on the business side. Mm-hmm. And so I could talk to chief investment officers as well as chief information officers. Mm-hmm. And I think that's helped me spearhead a lot of strategies and assistance to the buy side in particular over 25 plus years now. To help them get through and build out organizations. But the hidden thing beyond that is there are people I've influenced, younger people in particular, and it's like raising kids. You have no idea what you've told them that's going to be helpful and what is going to damage them. Like, you just don't even think about that. But there are young people I've influenced, and they've come back and told me many years, you did this and it really influenced me. I'm like, I don't even remember that, right? So I guess, you try to be a good example. And so for the positive things, I don't think I've, spawned any serial killers or anything like that, but the day is young, right?
Yeah.
So I think those two things together, being able to help the industry advance, particularly from the buy side, leverage technology, and influencing young careers and getting them on a healthy-ish path.
Well, that's wonderful, and definitely a great thing to be doing, and we appreciate you doing that. So thank you again for joining us on Whiskey and Wealth Tech.
Thank you for having me. Cheers.
Cheers.